you're going to try to aim for a partial. You just can't just feel like, oh, my elbow's twitching. The last time I had a muscle cramp like this and I was in a trade, it turned on me. So, I probably should take one now. Let me take a partial off now. You're trading from physical stimuli. You know what you're trading off of? Cortisol and adrenaline. And nobody's thinking clearly when that's going on. So you have to have your levels for targeting, whether it be partial or conclusion or terminus, where you're completely out of the trade entirely. They have to be determined before you enter the trade. If you can't time your entry and get in it with a target and where your partial should be, you shouldn't be entering the trade. Because what you're going to do is you're going to enter and you're going to find out how you feel as the trade goes along. And what that means is you may have had a small inclination of a market trading 10 handles, but because it moves 12 real fast and sudden, now you're in there for a whole day. And then you'll watch that profitable day. You might get 30 handles, 40 handles, 60 handles. And you're like, man, I'm going to the bank today, honey. Pack the bags. We're going to Vegas, honey. And at the end of the day, it's gone. And you lost $1,000, or you blew your funded account, or you blew your trading account. Instead of saying, I'm not just trading today. I'm trading until I can't do it anymore. And I don't have the mental faculties or the equity to do it, or the markets are kept from me. I'm going to be trading. So therefore, I have to do this as a business. I want to take profit at this logical price level. And I'm showing you how to logically frame out low-hanging fruit objectives. You don't need grand slams. You don't need to complicate it. And if you think this is complicated or complex, I don't know what to tell you, because there's all kinds of other stuff out there that's busy work. And it doesn't prove its effectiveness at all. I teach my students this stuff. They use it. They're on the leaderboard #1 spot in Robbins. They're cashing out. I got 1 million profit students. They've taken $1 million out of the marketplace using what I'm teaching you for free. I could go right into mentorships and start making millions of dollars again every single month. I don't want to. I don't need to. I love teaching you. I want you to learn it the correct way. That's why I talk to you in great detail, because I want you to know. And you're not going to learn it the first time you go into the video. You don't need to come back to my video and watch it and give me ad revenue. Download the video. I don't need your ad revenue. I really don't. I really don't need that. But I really need you to learn how to do it correctly, because there's a lot of yahoos out there that are teaching something they don't know anything about. And it's hurting more people than it's helping. And because they're using my terminology, but it's supposed to be rebranded bullshit, why don't you just go talk about the rebranded stuff that I supposedly did that? Call it what you think it's been rebranded and make it work in your charts. Make it work in a live stream. Make it work like that. Win competitions, get withdrawals from funded account companies, show broker statement, do all those things. Because I have students all over around the world that are doing that. And they're attributing what they've learned right from this YouTube channel. And some of them paid to get this information. You're not entitled to it, but I gifted it to the community because it's been abused by people. And to keep them from making money, I gave it to you. But I love teaching. I'm a teacher at heart. If you don't want to follow my rules, you can't claim that my results or your results are attributed to my concepts. You can't do that, because you're doing things inconsistently. And what I mean by that, what I said earlier facetiously, where if you don't have a predetermined level where you're going to take a partial profit at, based on the logic and the analysis that you're doing, you're going to be left to fall victim to whatever you feel while the trade's going on. And obviously, if the market starts going off the rails and parabolically in your favor and wildly beyond where you thought it was going to go, you won't be able to see anything except for dollar signs, and it's all going to be champagnes and bottles popping and Lamborghinis. You're just thinking, I'm getting rich on this trade. Everybody has experienced that. Everyone. Well, not everybody. There's been people that's never made money, but the folks that has ever had a winning trade that has gone beyond what they initially thought. They remove their stop loss. They don't have a target. They don't have any limit on it. It's just open-ended. I don't want to get stopped out, so let me take the stop loss because I know it's going to go to the moon. And that should never happen. It should never be allowed in your trades. You have completely lost the plot. You don't know what you're doing, and now you're gambling. You're literally at a slot machine just hoping that the 777 is going to pop up, or whatever it is that uses the payout. By having these easy objectives, these low-hanging fruit objectives. You don't need it to go to outside the range you're trading in. You don't need it to move 100 handles. If there's a logical reason for it to go higher or lower based on a higher time frame chart, and you can see a pattern that I've taught ad nauseum in this YouTube channel, that's it. That's your model. And if it's working for you, don't change it. Don't invite others to critique it. That means when you make a lot of money with it, don't go on social media and say, look at this. You want someone to say, well done, pat you on the back and handshake you. Someone that trusts their model and that can do it repeatedly and consistently, they're never going on social media and asking for approval. They have their bank accounts that's approving them every single week. Wow, I made more money this month than I had in the bank the previous month. I had this many withdrawals from my account. My broker sent me this much money. My funded account company paid me out this much money. What more do you need to make you feel good? That's real. The reason why you want to go to social media is because you don't have the consistency and you know it's probably not going to last. So you got to get it while you can. Get your accolades while you can. That's the wrong way of doing it. You put that stuff in your journal and you keep counting the money after you're out of the trade. You don't count it while you're in the trade, but you have to know when you're getting out. Where are you taking profits? Because unless you have that predetermined, you're going to lose sight of everything while you're in the trade. And that's going to affect your adherence to your bias. You don't think it, hearing me talk about it like this, but if anybody's ever traded real money or even trying to pass these funded account company challenges or whatnot, or the classic scenario, I only have $300 and then I can pass my funded account and I'm going to go for it today. I'm going to find $300 somewhere. And then you find yourself without an account. Classic, 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 classic. My best advice is if you're in a situation where you're right at the threshold of getting a funded account or getting a payout, that's the easiest way to say, you know what, I'm going to take 3 days off. Do something else. Because if you know how to trade, you'll be able to come back after 3 days and be sober-minded about it and get that last little piece and get it. But you're all in a rush. There's no reason for that. Like, if you do it fast-paced to get to it, look how many times people try to, I passed it in 1 day. Okay, how many payouts have you got? How many times did you blow those accounts that you passed in 1 day? The speed factor needs to be balanced with, I'm going to just do this slow and steady, and I'm not trying to do it quick. I'm not in a race with anyone else. I'm not in a race with statistical probabilities that a good trader can pass it in 1 day. That's a gambler. And yes, there's a lot of professional gamblers, but there's not a lot of professional gamblers that are profitable in trading consistently long-term. And if you want to be a short-term gambler, there's lots of ways to do it. I'm not the guy to teach you that. I'm trying to teach you how to be boring, how to be in here like a business, a job. It's not a surprise when you're successful. And when you're not successful for a day and you lose, that's not the end of the career. It's not the end of the business. You're not boarding up the building and saying we're out of business now. But that's predominantly what you see in this industry where it's flash, boom, here it is. Here I'm showing up. I'm here. I arrived. I got a funded account. I'm passed. And then they're using another account 2 weeks later. You shouldn't be impressed by your progress of how many times you can get a funded account. That should not be a measurement, ever. And I tell this to my own students, and sometimes it's met with emails saying, I thought you would encourage me. I am. I'm encouraging you to focus on what matters. Getting a funded account passed, where you're now able to take money if you're profitable and you meet all their bullshit extremes and levels. Now they're talking about you can't trade in a short span of time. Everything I'm telling you is going to happen, folks. It's just, you got to wait for it. These funded account companies, they're going to be gone. All of them. They're going to be gone. So you have to do the right things while you can, but don't rush it. And when you make real money, that money needs to be placed into a real regulated, reputable broker and trade with the least amount of leverage, never more. And then you get real experience. And when you can take money out of the marketplace and pay your groceries, pay your car note, and stop worrying about buying Lamborghinis and shit like that. If you don't listen to these rules, I promise you everything I'm teaching and have taught already isn't going to help you, because the problem underlyingly is you can't listen and you won't be teachable. The rules are there for a reason. They're created in a manner where they're low threshold. That means this is the lowest that you can reasonably frame it. And if you're not content with that as an initial objective, you're being shown that your expectations are too elevated and too high. And without any experience, you're going to be met with frustration because you're trying to do something you're not equipped to do. And you're going to fault yourself. You should have been able to do this sooner. You should have been, I've always been good and academic and everything else. My uncle was the same way. You can't equate that to being successful. But the underlying root causes are not sticking to a process or protocol. And if you're asking me to teach you bias, I've done that today. But you want something that is, this is what it's always going to look like. It's not like that. You're seeing where price has been, how you came from there, where you at right now. Are you still in a discount? Is it likely to go higher? Okay, your mindset should be, I'm focusing on how price is going to go higher. Now, right away, there's Tom, Dick, and Harry's mentorship guys out there saying, well, talking about the market and calling the market is not trading. Yeah, that's exactly the truth. Absolutely the truth. But you can't reasonably expect to be consistently profitable following a methodology, whether it be mine or anyone else's, until you have a process that you have seen work in the hindsight, that you've measured the data. It works this many times more than it fails this many times. Is there a reason for you to stick with it using the rules, not your own stuff, not your own elbow aching the last time I had that tennis elbow when the market went 150 handles, and now I got gout in my right big toe, and last time that happened, I blew my account. So you're equating everything and every catalyst for things that are outside of the market, because we're human nature. We're humans, rather. We fall victim to human nature, where we do things and we personify things that are never really factors that cause the outcome of anything. And that highlights the necessity for personal responsibility and accountability. And you need those to be paramount in yourself as the trader. When you make money, you made that money. I did not make that for you. My concepts did not make that for you. You did. You used something to cause the decision to be made. And then you stuck with that decision until the time that you closed that trade. I promise you, if you wrote an essay out on everything that you did using a winning trade and a losing trade, and you were honest with why you did it, what you were thinking, what you were feeling, every emotion, I promise you, the least factor will be my concepts or anybody else's methodology. That's the secret. You're the fucking problem. You have all this baggage in the beginning that you got to sort out. And nobody does an adequate job, unless you're talking to me, because I'm going to point out everything you're doing wrong, because I did all those things. And until I corrected them, I was not able to do this. I put all these other things in front of me when the least was enough. The least of these things that you're worried about is enough to derail you. The least in terms of profit objectives is enough to retire you. But you won't accept that. Why? What is the underlying problem? If you make $100 a day and you're consistently able to make $100 a day, if you can do that consistently, all you have to do is multiply that. That's the easy part. Multiplying is easy. Being able to consistently find that $100 cookie cutter. It may not be $100. It might be $200. It might be $50 for some of you. But you have to be able to measure this continuous approach to doing the same boring shit that has the outcome that is going to give you the end result you're looking for. You do not need to have one contract yields paying out $2,500. You don't need that. You just need something that yields you profitability. If you're an S&P trader, okay, let's take a quick look at S&P. ESM 2024. All right. Excuse me. Actually, you know what? We've been going for a little bit. Let's take a 5-minute intermission because I need to get something to drink and you probably need to use the restroom. So let's go for a 5-minute intermission here and then I'll resume. All right. So far, it should have been worth the price of admission, right? Tuesday and Wednesday is going to be much, much more invested in the time of reading price action live and explaining things. But we have to have the foundation. And like any book, you're going to have chapters that are essential information. That's what we wanted to cover today initially. If you discount that stuff in the beginning and you try to fast forward all that stuff, and you, in the past, when I let people comment on videos, they'll invariably have like the video starts at this minute marker. Their jerkers are never going to make any money. Like they literally are omitting the important factors. The stuff that you want to be explained why this is important, why you should be looking for certain things, and why you should discount other things outside of what I teach that are distractions. So anyway, real quick with the S&P, because I do want to spend at least an hour or so with live price action on very, very small time frames. We have a fair value gap here. We've colored outside the lines just a little bit, but we have this wick. See that? Remember I was showing you with the wicks on the NASDAQ? The same thing applies here. Consequent encroachment, which is the midpoint, that's level 5,190. The lower quadrant is a price I can't see. I don't know how to read that. Can't see it, so we'll try to get a rough idea. 51.78 3/4. Okay, so even though we can go outside of the range of this fair value gap, why could that happen? Well, if you go back to NASDAQ, we have a lot more range that could happen in unfolding buy-side delivery. Not buy-side liquidity. Buy-side delivery is just expansion higher directionally. It's offering buy-side delivery to NASDAQ in this area. We're below that fair value gap. So if things are allowed to see dollar go a little bit lower, but not undo everything I said about it, NASDAQ can go a little bit higher, but S&P is already inside its fair value gap. So what premium rate exists for it if it's going to be allowed to trade higher in sympathy with NASDAQ? Should NASDAQ trade higher? We have to use this wick. This wick is a gap. Okay, so we would look at the opening price here, the quadrant, the lowest one here, and the midpoint. Same thing. Now, with this, we have something that brings another depth of bias, narrative, prognostication in terms directionally, and also input that we can now use for market structure. If we close above this midpoint or consequent encroachment of that wick for the S&P, because we've already went above its respective fair value gap, like this date here, April 15th for S&P, that gap is the same gap that's here for NASDAQ, April 15th. We've not yet made its way up into this gap on NASDAQ, but we have gone to it and poked outside of it on ES here. So if it's trading here in ES and we close above that, that to me signifies that we're probably going to go higher and maybe and very likely take out the high. So that means we have a change in the overall market structure. And I mentioned this on April 8th where, because we're in an election year, yes, I'm expecting hundreds of handles lower. Seasonally, it's likely to happen. We've seen that. It's 1,000+ handles in NASDAQ that went lower. But if we see that it's an election year, the seasonal tendency in the spring can many times be abruptly changed, and we can see it resume going higher if it's a bullish year and it's an election year. So that would constitute, if we can close above that here, that might be a marker delineating the change in the underlying direction of the marketplace, where right now I'm favoring higher dollars, so that's risk off, and I'm looking for reasons for a higher time frame trade to be implemented. That is not to say that I won't take longs intraday scalping where I don't even need to have a bias. Okay. So all these factors build on the dynamic of understanding your daily bias, your weekly bias, and now I want to talk a little bit about session bias. Okay, we're going to go back into NASDAQ. All right, so here's what we have for the NASDAQ on the daily chart, and I'm going to drop right on into a 4-hour. Be mindful that these levels here, this is the order block's opening price on the daily chart for NASDAQ here, and the opening price on this down close candle, which is an order block. Those two price levels, we're going to study that in a little bit greater detail, and I'll try to teach you in concert with that and other things how we can trade without a bias. Because let me say this again, I'm not trying to encourage you to trade without a bias initially, because you're going to be challenged by that. Because what happens is when you don't need a bias, that means you have a whole lot more opportunities. And that's going to sound exactly what you're looking for. I have a lot more reasons to make a lot more money, when in reality, it just means that you have a lot more excuses for why you blew your account. Because smaller time frames offer a plethora of new, very short-term strikes where you can get in, get out, get 10 handles, 15 handles, be done. In and out, 5 handles, 6 handles in the S&P, you're done. What I try to promote is looking for one of those per day. You can study all the other ones that you'd be interested in, but try to find one that you would be real confident saying, okay, this is the one, everything's good. I'm going to try to get it and stop, because there's no other way to forge and build self-control until you start doing something like that. So please don't take this segue into shorter term time frame setups and reading intraday price action on these very small time frames. Don't take that as an invitation by me to say abandon everything and just go out there and just have at it, because I think it's more reasonable and responsible of you, and certainly of me as the educator here, to try to filter out the majority of the things that I know that you're going to see as a setup that isn't there. It isn't going to be a good setup. And that's part of the learning process. You'll know what your model is that you like and trust. And because you've been doing it enough, you'll know the setups that look like, I can see how someone else with less experience would see that's likely to occur, but I'm not taking that one. And when it doesn't pan out, that feels so much better than making money. You don't understand that right now because you're not profitable yet. But a profitable trader knows exactly what I just said is truth. Knowing when not to do something, and it did exactly what you thought was going to happen, where in your infants of learning how to trade or using your model or your concepts, whether it be my stuff or anybody else's, you just think you see everything all the time because you want it to happen. Maturity comes when you're like, okay, I can see how that setup could trip me up early on, but now I got more experience. I don't trust this one. Yes, it could pan out, but I'm not taking that one. It's not worth my money. It's not worth my mental capital. It's not worth my peace of mind. So I'm going to let that one pass. And regardless of the outcome of me not taking that trade, I'm okay with it. It's not going to change me. It's not going to create an impulse in me to now take another trade because I didn't do that one. So now I'm mad at myself. You completely eliminate all that stuff by having a bias and operating only in that. And then you forge personal responsibility and maturity, and then you'll have the end result you're looking for, but you can't envision it or visually see it within yourself because you're still in that doubting stage where everything is an invitation to justify why you shouldn't learn from me or even trade anywhere, because nobody makes money. Nobody does anything correct. Everybody's a scammer. So you have a lot of stuff to work out and wrestle with in the beginning. So the easiest way for you to get through that is have a protocol, a process, and stay within that. But the good news is when you get through that stage and you know what a real good setup looks like inside of bias, then you can graduate into saying, okay, I want to do exercises, and I'm going to show you how to do that today. I want to do exercises on how I can learn to read price action and expect certain things to happen in price and desensitize yourself. And when you're using lower time frame setups, you're gonna get a lot of them. You don't need all of them to pan out. In fact, in the beginning, it's good for them not to all pan out, because that's how you identify the ones that are better. You compare and contrast the characteristics of the ones that did pan out versus the ones that didn't pan out. And then you include the element of time, because the time factor is going to tell you why the ones didn't work. Hello. So we're going to look at a 4 hour. All right, so we have a 4 hour chart, and here are our respective daily order block levels. Notice that there isn't like 20 of them on the daily chart. There's not like 15, 7, 4, or 2 is good. 4, 3, or 2, that's good, because you're dealing with daily ranges, okay? And the expectance that you may have when you first start doing this is you think order blocks are happening every 5 minutes on every time frame. And you have to be reasonable, because in a protracted price run, that means where it's continuously moving in one direction, higher or lower. In an up move, ideally, you only want to see a few down close candles, because that tells you there's a lot of strength in this up move. If you see a lot of down close candles forming, that means either you're at the consolidation midpoint of halfway of that move, or you're probably near the high. In the next run it goes up, it's going to be that's the end of it, and it's going to collapse. And that right there, if you didn't write that down, you missed the whole thing today. Because down close candles in a up move, they should only be there for new opportunities to buy. Period. If you start seeing a whole lot of them, that means they're opening the auction up to, hey, look, come on, we want more buyers. And that's the red flag. The more down close candles you see in the time frame that you're trading when you're bullish, the more likely you're at either consolidation, and that's good news if you have a higher time frame objective or target where you think the market's going to draw to. If you start seeing a number of down close candles starting to form around in the general proximity of where you're at in price action, you're usually at a consolidation point. That means you're at basically a midpoint of the next price leg will repeat what you just experienced. So it's like a measured move type thing. Think of it like a classic bull flag, okay, where that pause, that little consolidation, is just the midpoint of the overall larger move. And a measured move is just a replication of the first leg up, now will be repeated, but many times it's done so in 3/4 or half the time. So all these down close candles and up close candles or order blocks, they give you intel, not just a entry or a target or a means of managing your stop loss, but it also gives you insight into determining the strength and the underlying probability of the continuation of that price leg or run that you're part of. Ideally, you don't want to see a lot of down close candles, but when you do see them and it does return back to them, you want immediate respect. If you don't get immediate respect, the same thing holds true. You probably are at a turning point, and any rally that comes off of that, the next candle or the next candle after that, within 2 candles of hitting that order block, if you don't get the responsiveness, or if it comes off of it just really lackluster, you're probably only trading up to a short-term premium, which would be model 2022 or a breaker, and then that's it. It's over, and then they're going to pull the rug and it goes lower. That's stuff that I've never taught before. I did not include that in the paid mentorship because I got jacklegs in there that are trying to sell it. So that's why I don't make content for them anymore. I answer their questions. I ask them, tell me what you would like me to address in this workshop. I'm addressing a lot of their questions and their concerns in this teaching, but I'm making it public. So that way nobody can repackage and, well, they will be writing books, all this stuff now. You'll see it's on Amazon. ICT secret to order blocks. He's finally spilled the beans. Whatever. The point is that I didn't teach this anywhere else before. And it helped me for 6 years in front of them live every single day, calling the market, telling them what was going to happen on a weekly and a daily, a 4 hour, a 1 hour, a 15-minute chart, a 5-minute chart. Like, I was on the record, and I was very consistent using these types of things that you now have in your hands. Just because you now heard me say the words doesn't mean that now you can walk out there and say, I can do this too, and try to push buttons and try to pass combines and whatever. You still have to go through that graduated stage in the beginning where you have to see it for yourself. You have to see when it doesn't work and ask yourself, why did it not work there? And do personal inventory. Are you upset about something? Are you mad? Are you impatient? Are you trying to force something because you want to do what somebody else has done and they got so much money as a withdrawal in a funded account company, or they did something in a competition, or they did this and that? You're trying to do things that are outside or external to yourself. And as a trader, you got to keep everything personal and private. And I know that doesn't fit some of you that want to be rock stars on social media, but that's all bullshit. Your house being paid off, your car having no note, your bills being completely paid debt free, and all of your utilities are constantly being met by one trade. One trade in one session of one day out of a whole month. And everything you make beyond that, after you have taken it out of the account and you've paid yourself, that's the real paying, not just closing the trade. You got to pay yourself. When I say pay the trader, that doesn't mean collapse the trade. That means take the money out. Take the money out. Go have a meal with your spouse. Take your wife out to dinner. Take your husband out to dinner. Spend it. Make it tangible. Because when you do that, it's going to inspire you to be diligent about following rules and not over leveraging and risking. Because you're going to want that experience more times than you just want to get the rush or the high out there, seeing a move happen in a demo or a funded account, which is a demo. And unless you get the money in your hands in your bank account and you spend some of it, it's an illusion. But that illusion is extremely powerful, and it's going to cause you to behave a certain way while trading because you're trying to keep up with the Joneses. You're trying to appease the people that are looking to you. But you invited that. And now you've created a situation where, hey, I'm not trading to make money anymore. I'm trading to impress other people. And that rarely works out well. So don't bother doing it. Does that mean you can't show a profitable month after it's done? No, it doesn't mean that. But as a steady diet, here's what I did today. Here's what I did today. You're basically giving yourself a report card and letting other people critique you. And that is going to impact your daily bias. You're going to second guess every little fluctuation. So you asked me to teach you daily bias. These are all part of that. Some of you are just saying, get on with it. This is all part of it, folks. My students that have made money, my students have suffered and never been able to find their own model and adhere to rules, I'm preaching to them. I've had students that just recently, even in the 2016 group, they have finally, think about that now, they have finally found profitability. What took so long? Them. You all have the same content. You have the same lessons, the same rhetoric, everything. But they are the issue. The ones that made money sooner, they were the catalyst. They didn't recklessly plunge in there and do stupid stuff or outside the parameters. They stuck to the parameters. So I'm teaching you today, I've taught you the process of going through the market, and you do the same thing with every asset class or market you're going to trade. But I start with the dollar index, because it gives me the risk on risk off scenario that I measure. That does not mean or equate that a higher dollar or a bullish dollar bias equates to let's get short NASDAQ, S&P, Dow, let's sell short gold. It doesn't mean all that. It just means that is where my mindset is. And I want to focus primarily on setups that fit that criteria versus just taking any old trade. Now, how do we use that for very small short-term time frames? Well, we're going to look at how in this little area here where we had that order block number on the daily chart, we're at the 4 hour now. Okay, let me go back to the daily. Here's the framework. Here's that last down close candle. So when we look at 17,530.75, and when we look at this price level at 17,682 even, that's these two respective order blocks on the daily chart. And they're order blocks because we're in the lower half, or in the discount range of this high to that low. See how that price leg just stands out? It just jumps off at the chart. You're using that as a frame of reference. This is the most logical price run we just had. Now, in that price run, there are smaller price legs. We'll talk about that on Tuesday. But for right now, for daily bias and session bias, this is enough. Okay. So they're order blocks because they're in a lower portion or in a discount relative to the range that you're using to qualify the down close candles to be a bullish order block. And because it's a higher time frame daily chart, they have a lot of influence over price. They're going to be very influential. So having them on your chart and drawing them out like this, what price are we looking at? Well, it's inside the zone. Wrong. It's the opening price. That is the change in the state of delivery. That means that the market will now seek buy side premium arrays or liquidity. That means buy side or buy stops. One of the two or a combination of both. But it's your job to go through the chart and say, okay, now where is there an inefficiency? When it traded down here, you're looking at this saying, oh, see, it failed. That's a noob trying to find fault at something. We're going to look on a lower time frame so you're going to see what I mean by this. When you have a higher time frame, monthly, weekly, or daily, or even a 4-hour order block, those levels need to be transposed to your lower time frames because they will absolutely have an influence on price. And you're going to see setups that completely have been never noticed by you. But they're the same things that I'm keying off of when I went on Twitter and said, okay, let's do some tape reading. I'm going to talk live and watch this one. And some of you were complaining about how I wasn't dealing with a chart because I was forcing you to look in your own chart because that's what trading is. You got to look in your chart. You can't make your money and profit in your account trading another person's live stream chart. You can't do that. You can't do that. Not in sleep at night. You can't. Now, that's not to say you can't support other people because I like certain live streamers. I like listening to them. I do not trade off of their information. I sometimes fade them in their crowd because then they get really, really animated about their opinion. And if it's opposed to what I expect to see in the price, then I have a purest form of market sentiment there is right at that moment at real time. And I'm going to be honest, it's not to brag. It's not to be, I'm trying to be very guarded in the way I deliver this because I have a tendency to go off the rails. And I've done it a few times here, but I've been able to dial it back. The number of times that my setup, when it's opposed to euphoric feeling about, yeah, let's get it, let's do it, or when they think it's really, really bullish or really, really bearish, if that is absolutely diametrically opposed to what I'm teaching you, and I'm in the market, I'm looking for a setup that's counter to what their emotional stimuli is being shared in public, when they're like that, I have everything, all boxes checked that I have a sure thing win. And I quietly just have fun with it. You can do the same thing because everybody wants to be a live streamer. They all want to show that they can make money. But the ones that offer their chat window, they are giving you a tool that you can tap into because that is real market vein. That's real market sentiment. That's somebody that doesn't know what they're doing telling you with a high degree of opinionated concern about the outcome of something they know little about. Who's going to know more about what? The people that are able to trade and not worried about talking in the chat room, following somebody else, trying to hopefully eat the breadcrumbs off their table, or someone that just simply does it and they don't care to be looked at or talked about and have all that stuff going on around them. Clearly, it's an outmatched competition there. The street money is going to be more prone to be incorrect. And that's why I like using YouTube live streamers chat window because they are the perfect market sentiment. They're perfect. They're flawless. They're absolutely 100% strike rate. They are on the money of losing. And I'm telling you right now, if you don't believe me, go and do it. That doesn't mean go into other people's live streams and troll them. But I sit in about 5 of them. And I'm not really listening to many times the speaker of what they're saying. I'm just scrolling through and watching the comments. When I'm seeing something form on the chart, I want to see, am I seeing the public see the opposite at that very moment? And the more exclamations, the more amped up they get about it, and more adjectives added to whatever. Oh, I'm backing the truck up. Oh, it's load the boat. It's going to be such big. It's going to the moon. I'm looking for those types of things that trigger a huge emotional commitment that they went so far as to type it in that chat window. And whether they are in a trade or not, the fact that they took the time to do that, if I see a lot of that, not just in one live streamer's chat window, but multiple ones, and I'm diametrically opposed to that view, then I feel like I have a good, strong setup. And then I might initiate the trade even with a larger degree of leverage because of that. So that's the other part of what I did. So without making any attempt at maybe trying to speak ill of anyone's community, I'm not trying to do that at all. But I'm being honest and telling you that's the benefit I get from it, because I'm not trying to learn anybody else's system. I'm not trying to copy anybody else's methodology of trading. Even if they make a lot of money, I'm not interested in what they're doing. I'm happy to see it happen. I'm glad that they are doing it. I'm glad that their community get to see it. But I'm tapping into a resource that doesn't hurt anybody. I'm not taking anything away from the individuals that are sharing their opinion anyway. So I don't have a moral dilemma with it. And if you do, and you think it's ill of me to do it, then I could care less, really. But this is a daily chart. We're going to go into these lower time frames, and we'll drop down to a 4-hour. Okay, and I want to take your attention into this right here. And I'm going to highlight that in yellow. So when we drop into lower time frames, everything in the yellow is salient to the order block and order flow. And you don't need anything like level 2 data. You don't need depth of market. You don't need DOMs. It's not DOM, it's DOM. We're going to study how price behaves in this area here. And I don't need so much over there. Yeah. All right, so we're on a 4-hour chart. That's all that's necessary on the 4-hour, okay? Everything's the same that we did on the monthly. Everything's the same on the weekly. Everything's the same on the daily chart. And now on the 4-hour, we have a little tiny inefficiency between here and here. Now, when I see something like that, and you're probably thinking, is that really an inefficiency? Yeah, of course it is, because that is touching the old equilibrium. And it didn't come down to at least there. So that is a gap, okay? That gap, I'll be more mindful to see what that does on a hourly or 15-minute time frame. So I'm not going to worry about framing it on a 4-hour chart. So we'll drop down into a 60-minute chart, which is hourly. All right, now, if you look inside here, we had this candle run above the order block. That's the lowest one on the daily chart. The next candle we drop down. What does it do? It does an immediate rebalance. Now, if you've never heard me teach on this, an immediate rebalance is where the market has a nice big bullish run candle higher, or a bearish candle that has a large range that moves lower. And the immediate next candle after that reprices to the previous candle, to that big candle that just formed. In visual terms, it's this. The market rallied here. This candle went above the order block. That's that opening price on the daily chart, that big blue line there, okay? When we went above it, the next candle we traded right back down. And what did it do? It went right back to the body or high of the previous candle right before that big candle. So when it does that, what I'm watching is it either will start its run in the direction I'm looking for, which is in this case would be higher. Either that candle or the very next candle. If the next candle does not run and it takes out that low, I am no longer interested in taking it along. I have to move to the sidelines. Immediate rebalance is one of the strongest things I have in my repertoire. It will basically be, like, say this candle only stopped with its low right there and didn't go as low as it did there. And it closed and it opened over here. What would it have formed? A fair value gap. But because the market is in such a rush to get somewhere where this would have been an obvious fair value gap, I'm watching this candle live. I'm watching whatever time frame I'm watching the trade on. I'm looking at how price behaves like this. And when it creates this big run like this and we open up here, I'm waiting to see, does it create a fair value gap? I'm already anticipating. I'm on record doing it. I'm on record calling an inversion fair value gap before they even form. I'm on record expecting an immediate rebalance before they even form. Go back and listen to the Twitter spaces. where I'm calling it. Look at the tweets. I don't delete one tweet. Not one tweet has ever been deleted by me. But when it trades down to the high or the body of that candle like it does here, in my mind, if I'm bullish, that's exactly what I want to see happen. And if I can't get in on that candle, as soon as the next candle opens, I'm buying it at the market. Immediately, I want to just be in it. Why? Because it's going to perform just like this. If I'm right and everything is equal and I'm on side, that's exactly how the market should behave. And you do not see anybody teach that anywhere. Sorry, but that's just the way it is. The market's going to reprice at that price point and immediately run. And it has nothing to do with this order block. That's just one more qualifying thing for it. It has nothing to do with this breaker right there that's bullish. Low, high, lower, low. Take that range, extend it over here. That's another trade entry. I'm talking about what I'm seeing in price. That candle, when it opens and trades right back down to that candle's high, I'm in it. If I can get in there, I'm in it. Where would your stop loss be, ICT? Low of that candle, or at least the mean threshold of that candlestick's body. It would be this. Watch. That's midpoint or mean threshold. My stop loss has to be below that. And honesty, it would be really at that opening price. That's where I'd have it at. And however many contracts I can afford to take and trade and use whatever risk parameter would be. Say I was risking 2%, 2.5%. However many contracts I can afford to trade in that, that's how many contracts I would take. I would not be worried. I would not be panicking. I would not freak out. I would expect it to do this very thing. And I've shown examples of me trading with it, executing live with it, with an AMP account. I've done it in TD Ameritrade account. I've done it with live calling the tape. I've done it with demo accounts. I have example after example of it. All you got to do is go watch the stuff. It's there. But the logic is, if we get a big run candle in a direction that we're looking for, the very next candle, I'm waiting to see a fair value gap form. But if we're lucky and fortunate enough for it to come right back down to it there, man, we are in a loaded deal. It's the loaded deal. Why? Why? Did you already forget what I'm talking about already? Where is it forming? What's this blue level? That's that daily order block. It's opening price. It's not a fucking zone. It's a very specific price level. It's not ambiguous. So you need to be looking at that level in a lower time frame. And we're only on an hourly chart. You think it's just a 1 minute chart that I'm teaching students to trade on? No. You want to capture nice day trades, you're going to be using the 15-minute and hourly chart. You want to trade swing trades, you're going to be trading the 4 hour and the 1 hour chart. You want to trade position trades, you're going to be trading the daily and the weekly charts. And the same stuff occurs there. You never, ever, ever need to go below an hourly chart. You don't ever need to do that. I am just an action hound. I know I can do a lot of things in a 1 minute chart, less than 1 minute chart. And that's not trying to flex. I have a very quick decision-making mechanism in my brain. I can change on a dime. And I can trade up, down, up, down, up, down all day long. You may not be equipped to do that. It doesn't mean you're stupid. It doesn't mean I'm superior. It just means that I matched my personality with a time frame that it works well with me. 1 hour is just too damn fucking slow for me. Like I want more. Like I need to be in there doing more. And the way I've done that, because I have the experience, I have the maturity to be able to balance and be responsible with the outcome. If I lose, I can eat that. You might not be able to do that. It might be too much for you to take, 6 trades in a day. It might be too much for you to take, 12 trades in a day. And 1 trade a week may be sufficient for you, and it's hard for you to get beyond that. Okay, there's nothing wrong with that. Focus on the 4 hour and 1 hour, using the process of determining bias. But the magic happens when you start applying all these things together that flesh out a narrative. Over here, what's this blue line? That's that higher daily order block, the opening price, not some random level. It's the same level all the time. all the time, because that's the change in the state of delivery. What does that mean when ICT says it's the change in the state of delivery? Prior to that candlestick forming, the market was going a direction. It was going lower. It was a move that we called and talked about on April 8th's live stream. I said that we're going to see several hundred handles lower. I didn't talk about going higher, going lower, and it was based on seasonal tendency. Because of that, when we have a turn, you don't need to know when it turns. It can stop you out of shorts and prove to you that it doesn't want to go any lower. Then you start measuring what I've showed you here on the daily chart. But if you want to use it to probe any long positions, or if you're confident and convictions are strong enough, you want to be a buyer and hold for longer positions higher, you can key off those daily levels like this. But in short, what's happening is if you have an order block opening price, whether it be a bearish or bullish candle, you need to have those levels transposed to your lower time frames, because you're missing trades, and you're missing many times the best of the best. Now, what happens if you can't get in on this move? Then you have to enter inside this range here, and you may or may not get an opportunity to do so. It just might happen that you don't get an instance where it can come back down and trade below a 1 minute swing low for sell side. It may not have a fair value gap that it trades down into. It may not give you a 1 minute or sub 1 minute bullish breaker. All those things can form inside this. That's why I taught every PD array that I was willing to share, because they all can be used to get into a move that's already started without you. And it will not technically be chasing, because really what you're doing is you're keying off of what a high frequency trading algorithm is going to do anyway. This isn't the only time to enter. This isn't the only time to enter. There's other places to enter, but those other places need to be balanced, because I can take and add into a position that's already established at a lower price when I'm bullish. In that new entry that's being pyramided in, because I'm using smaller position sizes to add more, I can weather deeper retracements on that later entry, knowing that it can do that. I'm not upset by that. It doesn't change my convictions about the trade. It just means that I have a smaller position. It's incurring a little bit more drawdown because I've added more, but I want to be a part of the larger move that's going to happen after that retracement. So let's look at this little piece of action in here. We're on an hourly chart here. So when it dropped down, it touched that higher bullish order block, the opening price. So it's going to act like what? A trampoline. It's going to spring. It's a change in a state of delivery. Delivery is directional price run. That's what that is. So if there's a change in a state of delivery, that means what we're saying is there's going to be a change in the direction of price. So if it was dropping, when it went down into this level here, went lower, lower, and then we round above it, this candle, the first return back into it there, what is it coupled with? It's coupled with an immediate rebalance. It's a bullish breaker with this candle here. A breaker is when you have a low, high, a lower low that takes out sell side there, and then rallies through it. As soon as we come back down to that highest up close candle, that body extended over, that right there is your bullish breaker. That is your order block. That is your immediate rebalance. That is all occurring at your daily opening price, which is this change in the state of delivery. That means what's occurring? The algorithm that you don't believe exists is now going to spool price higher. And I'm sorry, Chris Lloyd never fucking taught that. And if that offends you, go fuck yourself, because I'm tired of people leaving comments in there. I've already had Chris Lloyd come out publicly on Twitter and tell you that his shit ain't in mine. Done. But this rally, when it runs, what is it reaching for? If there's a change in the state of delivery, it's going to seek the opposing side of what? Liquidity or inefficiency. That occurs right here. To the left, what do we see? Well, we have this little inefficiency here, but it's short order to do that. We don't need it. We don't need it just to trade here. We need it to show us a run. Right in this price fractal that I'm showing right now, where's it reaching for if it wants to go to buy side? relative equal highs right here, and what? That high. Wasn't that convenient? Bang. So your model could be based on using this higher time frame order flow around a bullish order block, its opening price, which is not ambiguous at all. It's a very specific price level, very specific. And you drill down and you look for PD arrays to converge around it that supports the idea that it's going to do what? Go higher. Because the change in the state of delivery means it's going to start going higher. So if it's going to go higher, pray tell, what is it going to go up there for? And to where? It's going to go to any inefficiency in close proximity or buy stops. That's buy side liquidity. Friends and neighbors, that is short, sweet, to the point. You can't reduce it to anything less than that. It's right to the point. You can't make it any plainer than that. Now, the same thing we apply to this opening price on the higher daily order block. What's occurring here? The market creates a consolidation, and it needs to do what? It drops down into a short-term discount. What does it trade to? The order block's opening price. When it does that, it's going to act like a trampoline. Meaning what? It's going to go down to it, press into it, and spring higher. By itself, it is not useful. You need to see other things confirm it. That's what makes it an order block. If it's just a down closed candle, that means absolutely nothing. It means absolutely nothing. The price action signatures that you're looking for is a confluence of other factors that would support the idea that it needs to be responsive at that price point, at that time. Think. What else is occurring right here when it drops down and hits that order block's opening price? What's it reacting off of? What is this? Buy side imbalance, sell side inefficiency. This is buy side delivery. It's inefficient in what? Sell side. Well, if we measure that from here to here, what are we looking for? The best buys are going to be at what? Midpoint or consequent encroachment in the upper quadrant. Where's the bodies at? Forgot about that, didn't you? The bodies are telling you, they're telegraphing you that we're going higher, but we got to damage some people first. There's some bull flag traders in here that already tried to go long, so we're going to have to stop them out. But is the algorithm just going to go pull some random number out of its ass and say, well, we're going to drop down 300 handles before we start going higher? No, it goes right down to consequent encroachment, which is the midpoint of this buy side imbalance, sell side inefficiency. See, you want it to be like Chris Laurie said, where it can come down here and close in this liquidity void. That's not what I want. I don't want that. I want this piece left open. And I'm sorry, but he's never taught that. Never taught that until I mentioned it. This needs to stay open ideally. Okay? That needs to stay open. The best buys are going to happen in the upper quadrant. What looks like a premium to you, but it's not. That's the ideal entry because you're already in a discount. You didn't get the lesson. You didn't study it enough. You just want the buzzwords, but you don't know what you're doing when you got there and try to force something through ignorance. And I know that it upsets you when I talk to you this way, but there's a small sect of my community that goes around beating their chest thinking they're superior to everybody else because they can talk like me, but you can't walk like me. And it's offensive to me as your mentor, and I'm sure it's offensive to everybody else. There's a right way to do it, and there's a wrong way to do it. And this ain't rebranded anything. This is my stuff. We don't want that lower portion to be closed in or overlapped on. We don't want that. Because what that indicates is it's exceedingly bullish. This will act as a breakaway gap. That's exactly what we want. We want to see that. If we get to a consolidation place in the price run, and it creates a gap like this, where we want to leave a small portion open, that is a measuring gap. But the fact that it has to be part of a larger consolidation, or one leg of the price run's already occurred and then we're consolidating, and then we get another gap where it creates an environment like I'm explaining here. If it stays open, that to me is going to be a measuring gap. That means it qualifies that we have another price leg that's going to be equal to the initial move, or maybe even more, but it's going to do it in 3/4 of the time that it took to make the first leg, or less. So what does that mean? Many times that's your second stage reaccumulation in a market maker buy, or a second stage redistribution in a market maker sell model. Hot damn! Did he just give some gold? Yes, I did. And for free. You're welcome. You're absolutely welcome. I'll be here tomorrow and Wednesday. But let's dig into a little bit more detail right down here. This is an hourly chart. That's our higher time frame bullish order block, opening price. It's the change in the state of delivery. That means what was it doing? It was just dropping down. We're going to anticipate what? That trampoline, that springboard effect off of that level. We have to have something else. We already have it on the same time frame, which is consequent encroachment of this buy side and balance sell side inefficiency. Why? Why should you have that rule? Because ICT teaches that you don't want to see every imbalance completely closed in. That's what gives you the narrative. If it's always able to come back down and fill in every single buy side and balance sell side inefficiency, we're probably near the end of the price run. Think. They don't have any time to waste. If they're going to come down here, that means it's going to be a lethargic price run. I don't want to be a part of that kind of stuff. I want to be in the ones that take off and it's like, what the hell? This thing's flying. It's like hyperspace. Warp speed, like Star Trek. Remember when the Enterprise would just take off and everything's a blur? That kind of felt like when I was on my motorcycle doing 155 mile an hour on Pulaski Highway. I could only see like a 6-inch diameter right in front of me that was clear. Everything else was a blur. What a fucking high was that? It was amazing. That's the kind of trades I want to be a part of. I want to have immediate feedback. I want an immediate handshake to profitability. I'm not wasting any time. I want to be in the trades that immediately talk back and say, yeah, you are the shit today. Stomp around, peacock. Do everything that makes you feel good because you got a winner. Hold this motherfucker because it's going. It's going and it's going. And there's no doubt about it. Nobody on the internet is going to take you out of that. You're dialed in. You feel good because everything you're looking for is there. And guess what? When you can trade like that and you're willing to share it live and public and everything else, it comes across as arrogance because those people can't do it. And I let them have that moment. Let them feel like they're talking down to me. Oh, you're arrogant. You're pompous. You're a bragger. You're this, you're that. Whatever. When you can do it, you're gonna feel the same way. But I'm not going around stabbing people in the eyeball with order blocks saying you're stupid because you can't trade them. I'm literally giving it to you. I'm teaching it to you. I want you to experience what it feels like to do this stuff properly. I would be completely irresponsible as a mentor to sit back and let everybody else out here misinform you with ignorance. I want you to succeed. I want you to have success. I want you to make more fucking money than you ever dreamed before. And then when you have that money, I don't want you to be selfish with it. I want you to do something nice for other people. That's the story I want. That's the payback to me. I want that. I want that testimony. I don't want, I just bought a new car. I bought a new house for my mom. That's wonderful. But what did you do outside of your own? That's what I'm looking for. That's how you pay me back. Because all the other stuff I get, it's like, okay, whatever. But hourly chart, we're going to drop down to a 15-minute time frame. We're focusing primarily right in here, okay? We already have one qualifying thing, which is the consequent encroachment of that buy side and balance sell side efficiency. It should leave this portion open down here. In hindsight, yes, we can see that's happened. But that's the rules that I've taught on Twitter Spaces. That's the rules I've taught in lectures. I just taught it in the recent teaching on April 8th. You want to see that lower portion not filled in. The more times you see that, man, that is telling you this son of a bitch is going higher. Stop looking for tops. Stop trying to go short. It's going higher. It needs to go somewhere higher. That's what it's indicating to you. You can't get a better visual representation of confirming and qualifying a setup than that. That is the signature that I'm looking for. If I'm trading a bull flag, I'm not a bull flag, a bullish order block, I want the lower portion of that candlestick not to even be traded to. It can touch the mean threshold halfway point, but if it does that, it needs to immediately kick off and start running. If I'm trading a fair value gap, and I'm bullish, I want the upper portion to be responsive. I don't want to see it dilly-dallying around at all in that lower half. I don't want to see that. If I start seeing that, as soon as I see any momentum waning after it starts to run, I'm scaling something out. I'm more inclined to start taking partial. Why does ICT take this many partials off here on this trade? I just fucking taught you. I literally just told you. Now imagine, okay? Imagine that you sat down for the first time. This is your first time watching or listening to me. This shit sounds like another language you've never learned. Still. And it still talks, it seems like, oh, it's the hindsight. But you've watched me do it if you've been around for a while. You literally watched me trade this. You literally watched me call it live on Twitter. Minute by minute, 1 minute candles, outlining it, why it should do this, where it's going to go next, all that shit. I go in other people's live stream and I tell them where it's going to go before it happens. And still people doubt this stuff. You can go out here and do everything in front of them and they're still going to find some fault with you because they can't do it. So don't invite them into your problem. The problem is you solving who you are as a trader. And when you see these signatures repeat over and over and over and over again, it builds confidence. And when it's so open, it comes across as arrogance. It comes across as prideful. It's not. It's confidence. It's unshakable confidence that nothing else can come close to this. And when you get that and you tap into that, there's absolutely no fucking person on this internet that's going to talk you out of the way you feel about it because you experienced it. You lived it. You're walking it. You're making their yearly fucking salary in a week, laughing at them without needing to do it publicly. That's living well. That's the best fucking revenge. That's the best revenge. Let them talk all the shit about how you're never going to learn how to do this stuff. It's never going to work for you, blah, blah, blah. I got people that are millionaires now. Hello, millionaires that had the same shit told to them. Who are you going to believe? Who are you going to believe? You're going to believe the guy that's creating the people for free. They don't have to pay for this stuff anymore. They're going out there and they're making life-changing amounts of money and changing their whole dynamic. Their whole fucking family tree has been uprooted and planted in a new vineyard because they took the initiative to say, you know what, I'm just going to try and see if this stuff will work for me. And I'm going to put some real effort into it. Not 2 weeks, not a couple months. I'm going to stick this out and see if it works for you. And as you go, you'll see progress and you'll see things that will increase your tenacity to stay with it. And it becomes infectious. And that's why many times we are a cult. And we are the fucking cult of winning. We win around here. We win. We don't guess. We don't get in a fucking trade to make 7 handles and say, okay, it's a lot of fucking pressure. I got to get off of this, man. And then look at this. I called it. It went 50 fucking handles. No, why aren't you in the 50 handles? Why aren't you in the 50 handles in the same account that you passed? There's a problem there. You need to fix that. That's an opportunity. Instead of addressing them, you're trying to appease an audience. Fuck the audience. Let me tell you something. I want all of you to do well, but if you don't have an opinion of me as someone that's trying to help you, and you think I'm a piece of shit, and I'm not trying to be here to do anything to encourage you or do it the right way, I don't really care about your opinion. It has no bearing on how I live. The people that give me feedback and say, you know what, I really got something out of this. It inspired me. It showed something that I had an uncertainty about something. I had a doubt about what I should be focusing on here. This helped me focus on what it is I should be looking at. It really made a structural process or procedure that I need to go in and look at. This helped me. I do it for that. There's no ad revenue on that. That is exactly what I'm trying to tap into. People that are willing to want to learn how to do this correctly. They know it's going to be hard work. They know they have to overcome a demon and maybe demons in themselves that are going to be plaguing their development. I didn't cause them. Maybe you didn't cause them, but you all had them. I had them. I still wrestle with a lot of stuff. But you still have to wrestle them and put them in submission and then stick to a process of learning how to do this. Because if it's not going to be this, what's it going to be? Moving average crossovers, okay? Is it going to be pivot points, harmonic horseshit? You know, what's it going to be? Because until you fix the you problem, all these things are going to resurface, and you're not going to focus on the processes that work if you give it enough time and effort. So we're going to drop down a 15-minute time frame. Again, we're looking right at this price level right there. Gotta climb off my soapbox. Same thing in here. We're looking at relative equal lows. So there's a sell side liquidity pool being engineered there. Look what they do. They run first, higher. So what does that do? It triggers longs. Why would they want that? Because if they're going to go long, they're going to put what? Sell stops. Where are they going to put them at? Below the relative equal lows. Well, then that's convenient because right down here is that order block. And right down in here is that consequent encroachment of the 1 hour buy side and balance sell side efficiency. So now we have liquidity engineered right at a buy side and bell, sell side inefficiencies, consequent encroachment, or midpoint of that gap. Is that 3? That's 3. That's 3 things. We have inefficiency being factored in and liquidity now. So when it hits this price level, what should it do, ICT? It should act like a trampoline, springboard higher. Does it do so? Absolutely. So I've taught you how to look at order blocks, how to qualify them. They got to be in a discount or a premium. The higher time frame ones, you need to transpose those levels to the lower time frame. And when you go into the lower time frame, you want them to be in agreement with at least 3 PD arrays, 3 more things to justify it. The level of a order block's opening price or mean threshold is in and of itself, by itself, useless. They are the markers in which you go into price and you study around that. And if you have 3 PD arrays, 3 reasons, whether it be liquidity or specific price levels that is a PD array. Liquidity is always a PD array, and it's dynamic. It can be in any time frame, any level of premium or discount. But when it's coupled with a level that is expected to promote higher prices, it's a slam dunk. Like, it's a slam dunk. There's nothing to consider about it. It's easy. It's just waiting for you to get in it. If you don't get in it, just take the next one, because they're going to repeat every week, every day, and it won't stop. That's our moniker here. It never changes. It just gets more precise. It gets more detailed, more confidence building, because we're not reinventing anything. We're not changing parameters. We're not moving the goalpost. We're not saying one PD array is growing in popularity, so therefore that's the better one. Any one of those PD arrays can be a catalyst. And that's why it's important for you to just pick one to warm up to first. But you're going to want to go into all of them eventually for you to get a well-rounded, comprehensive visual representation of what price is doing algorithmically. So here's what it looks like on the 15-minute chart. We'll just drop down for shits and giggles on the 5-minute chart. Excuse me. Last down close candle, displacement to the upside. Did we trade to consequent encroachment of that buy side and bell, sell side efficiency, and the upper opening price on the daily bullish order block, that level here? Yes. Did we see displacement? This candle? Yes. Last down close candle. What is the change in the state of delivery? What price is it? It's the opening price. What opening price is that? Look right up here. What opening price is it? 17,710 and a half. Price comes down, trades to the low of that candle. What's the low? 17,709.25. Did it respond? Did it respond? Did it prove there's a change in the state of delivery and algorithmically repriced higher? You're going to tell me that's buying and selling pressure? That's buyers came in there, right? Buyers did that, right? Yeah, I love it. I love it. I love reading people talk that bullshit, because that didn't happen. Okay, that did not happen. Price expanded higher. And then what do we have here? You missed this down here. You weren't able to dial in. No problem. We're on a 5-minute chart. We're in a 5-minute chart. We're still below equilibrium. So we're in what? We're in a discount. So can we take a fair value gap entry? Absolutely. Yes, we can, Virginia. So watch. Here is your fair value gap right there. See that? We're going to take this off because we've already highlighted the area to start looking for the setup. But right in here, where's the best entry, ICT? Can you just cut the bullshit and tell me how to buy a fair value gap appropriately? Tell me where to put a stop loss. Where's the best entry? How should I trade it? Okay, you listening? You're listening. Put the fucking Doritos down. Take your headphones off with your music while it's pumping behind me talking. Listen. This candle right there, okay? You want your entry to be in the upper portion, that price level or higher. You can save yourself a lot of heartache by just simply going in one tick below the high of it. Your risk is the low that creates the fair value gap candle. Determining how many contracts you can afford by whatever risk parameter you're using, While you're learning, use 1/2 of 1%. And that means you're probably going to be using micros. And guess what? That's not a problem. It's only a problem for short dick energy people. So if you look at this right here, that gives you your framework. What was the midpoint here for consequent encroachment? 17,770.25. It trades down and offers that price level plus its tick. The low is 17,768 and 3/4. Spread's not going to be a factor there for you. I never, listen to me, folks. This is a constant. I never use the consequent encroachment level as a limit order. I never do that. There was times when I tried to do that because I wanted to be really, really in there at the lowest low, and I wanted to be Mr. Ego, Kid Ego. Okay. I missed some really good trades, some phenomenal trades, like huge, huge runs, because I demanded that much precision. There's a balancing act here that you're going to have to manage, okay? If you don't get the lowest low and you're off by 2.5 handles and you're able to capture 100 handles or more, risking, not very much at all, are you going to lose sleep over that? Because if you are, you have some work to do. Your expectations are too high. The upper portion of an order block, from its midpoint to its high, every fair value gap from its midpoint to its high, if you're buying, that's your ideal entry. Is there anything wrong with trying to buy the midpoint between consequent encroachment and the high? No, that's usually that's a sweet spot where I like to do most of my buying. My largest portion entry will be in that vicinity. And then sometimes when it's still meandering around in here in the same candle, I might fancy dance and add a little bit more, because if I see something in a chat room, or if I see a lot of chatter about something that's opposed to what I'm in, I'm going to try to get on that same candle that's there, because I might not get an opportunity for it to come back and revisit this area again. But it's important to know that you don't have to be the perfect entry. I've wasted decades, folks. I'm going to be honest with you. I've wasted decades trying to do something that I've not been able to dial in on in perfect exits. But you don't need perfect exits to make money. The same side of the equation, you don't need perfect entries. They don't need to be perfect, but they have to be logical. They have to be in a capacity that allows you and affords you to manage the risk that's associated with that setup. And if you discount the necessity to manage the risk and only try to look for the largest position size that you can place on every trade you enter, you're doing it wrong. You're doing it wrong. You're going to be inflicting more needless scar tissue that will never go away because you're trying to do things your way. Your way, in ignorance. You think that you're going to come out here and do it better than somebody else that has proven, with other people listening to them, bringing home the receipts of that. You're going to be the head of the class. You're going to be teacher's pet. You're going to do it your way mentality. I've had so many students come to me and try that approach in tearful emails and voicemails and sending me face-to-face videos where they're literally telling me, like, this is what I've done. How can I fix this problem? I've done this, I've done that. And I said, go back and listen. And they put down all their other reasons why they're trying to do it. They put down, I'm trying to look good in the eyes of social media. I'm trying to just focus on making money. I'm not trying to impress my ex-girlfriend. I'm not trying to impress my anybody. They're trying to get good at it for the sake of being good at it, because the default to that is you're profitable. How profitable will you be? That's determined upon how much you can manage money. And that's a lesson outside the scope of all this, because it's reasonable to assume that, if you do the right things and you're not over leveraging, you should be profitable. Should is not a guarantee, but you have to have a framework. You have to have a foundation to build upon before you can reasonably expect that is going to be the outcome for you. And if you're not willing to subject yourself to the process of going through this, looking for it in hindsight. That's how I did it. I went back and I found them and I said, okay, these things tend to happen all the time when this occurs. When these confluence of events occur at this time, go back and look at the examples. What time is it happening? What candle time is it on right now? Hard not to grin, isn't it? There ain't no fucking macros. No, there ain't. Let them believe it. When they say it, let them believe it. Don't try to convince them otherwise. Let them stay in fucking ignorance. Let them stay there. They chose it. They ain't done the due diligence to go back and see and prove it to themselves. Let them stay stupid. Let them stay stupid. You can't fix stupid. I've had a lot of students come to me with a case of the ass and they knew how to be taught. You need to teach me. Get the fuck out of here. Get out of here. I ain't got time for you. Goodbye. Banned. Goodbye. If you're not willing to listen, because all the evidence is here. You can see it working. You've got students all around the world proving it. What's keeping you? Your elevated expectations and trying to live up to them. And you're doing it all wrong. It needs to be boring. It needs to not keep you up at night. If you're worried about this shit in bed before you go to sleep, your expectations are too high. They're too high. You're placing too much pressure on yourself. Relax. This stuff is not hiding from you anymore. They cannot hide it from you. They cannot hide this from you. Okay? It's always going to be there. As long as these markets are trading, these things are always going to be there. Why? Because people are greedy. They're going to buy and they're going to sell. And when they put a stop loss in there, it's waiting to be fleeced. Nobody's going to turn the industry upside down and say, here's how you trade properly and never need to use a stop loss. That's not going to happen. There's a lot of people try to do that on YouTube. They try to sell that idea on Instagram, maybe on Twitter. But that shit don't hold water. That dog won't hunt. So you need to stop worrying about, they're going to change that. They're not going to change shit. There's a new line of suckers coming in trying to use John Murphy's bullshit. Okay? There's always new people coming here all the time trying to trade support resistance and moving average crossovers. There's a whole cult and religion around zoo patterns. Harmonic horseshit. That stuff doesn't have any bearing on why price is going to do what it's doing. Nothing. It has nothing. It's just, that's a convenient anomaly. That's all it is. Because large institutions are not basing their they're not basing their trades with billions of dollars on the basis of a fucking harmonic cactus pattern that, some goober draw some kind of a emblem or whatever on a chart and says this is what it is. That's a gimmick. The market goes high for inefficiency or stops. The market goes down for inefficiencies or stops. Prolonged moves just goes for further out liquidity or inefficiencies. It's not buying and selling pressure, period. It's controlled. Absolutely 100% all the time, 100% manipulated, controlled, and delivered based on what they want to happen. That's how it is. That's all it is. It's a big casino, and all you have to do is walk the aisles. Walk the aisles and wait for street money to get off those slot machines that ain't paid out to them. Because they can't see the opportunity. They can't see the opportunity that they've created by leaving, by being on the other side of the trade. The other side of the trade where they think that this isn't going to go up for me. It ain't going to pay me out. So I'm going to leave it. I'm going to go chase another setup, another pattern, another machine, another approach to trading. And right when they are diametrically opposed to when you want to be entering a trade, you sit down, you put your money in the trade, you pull the arm down, and you wait for it to deliver the 777 jackpot. And when it pays you, you get the fuck off that machine and leave, and you wait for another day, another opportunity. Not, wow, I just got this jackpot. I'm going to put some more money in this same machine, expected to do. That's what you did when you won money in your account and you trade, and you wasn't satisfied with it. You go in and you turn that winning day into a losing day. How many times have you seen people do that? How many times have you done that? Could it have been avoided? Yes. When you make money, stop. Stop. But you could make more. Yes, you could. And you can make more of an ass out of yourself by giving away a profitable day. And it happens every single day. So there's a long line of suckers coming in here every single day. New money, new street money, same logic. I'm going to get real rich real easy because Instagram boys told me. Anyway, I'm having a lot of fun with this, I'm going to be honest with you. So we have a gap here. What time of day is that? New week opening gap. Okay. New week opening gap. That gap many times will be retraded to, not just once, multiple times. Multiple times in the course of a week. Every single time you see an opening gap like that, I don't care if it's one tick, that's always in my analysis. Oh, come on. I'm telling you right now, it's just that simple. That opening gap will be referred to all week long when price is in close proximity to it. Many times it can act as a target for a trade. Many times it'll act as an entry, and or it can be it can act as a buffer for a level for where your stop needs to be above or below, because it can reprice to it all week long. And if you start putting a stop loss right at that same general area, you're asking for it to be hit. Yeah. And the same thing with a new day opening gap. End dog. If you place your stop loss on any trade inside a new day opening gap or a new week opening gap, you're basically saying, here's my ass, back up into it. Don't lube it. You're asking for it. You're begging them to do that to you. Until you learned about it, you never would have understood that principle, but that's what's going on. You don't want to place a stop loss in a level that is more prone to be revisited. You don't want to do that. There are times when an order block or a fair value gap will fill in that entire range. It doesn't mean it's a bad trade. It doesn't mean that it's not going to run for you. But when it does completely close in its range or completely trade all the way to the bottom of the body of the candlestick that makes it the order block, then you must demand superior price delivery where it's got to be explosive. Like it's got to be off the rails volatility, straight one direction, one line, straight win, right to profit. No dilly-dallying around, no consolidation, no bull flagging, none of that stuff. It needs to be absolutely like a bullet taking off right to the target. Because if you don't treat it like that and you don't take partials, it's gonna turn into a losing trade. It's simple, isn't it? It's hard waiting for it. It's hard managing it and thinking about all these things while you're in a trade. Now think about how hard and complex you think it is right now, and then I got to type all this stuff out while I'm doing a trade on a 1 minute chart or a 30-second chart or a 15-second chart. That proves visibility. That proves that, number one, I can convey the idea on Twitter, either typing it out or talking it audibly in a Twitter space, referring to every one individual 1 minute candle. If there wasn't a logic behind it, I wouldn't be able to do that. But because there is a logic behind it, because there is a reason for it, it can be repeated. And that means you can learn how to do it. And you won't need to come back to my YouTube channel. You won't need to worry about what I'm doing. How did you trade today? How did you do this? And what market did you trade? You won't care. You won't need that outside confirmation or encouragement. Your results will be encouraging enough. And that was a very hard thing for me to learn, where I had to find the approval. As a young boy, I always sought that because my parents, the whole show I gave you before, they didn't want me. So I had to always seek approval outwardly. And the results that you find in doing the right thing controlling your method of managing the money and the risk, and then seeing how it delivers and pans out, and you grow as a trader in your understanding and your results. That is what you'll get the attaboy, attagirl for. That's the approval that you're really seeking, and being content with that, not needing to have outward confirmation that you're a really good trader, or you're a really good tape reader, or you're a really profitable trader, or you're better than that trader and that trader. Look, all of that isn't going to help you pay your bills. It isn't going to change your legacy wealth. It's a distraction. And what that's doing is it's appeasing the discomfort that you're feeling while you're learning to get to the point where you're bored with your results because you know what you're doing works. Doesn't mean you're going to be profitable every time you take a trade, but by far and large, your monthly results should be net gain. Your yearly results should be net gain. And having any conclusion about how it should be better, it would have been better if you do that, you're creating scar tissue. Don't do it. Don't compare yourself to me. Don't compare yourself to other traders. Don't allow yourself to be compared to by anyone else. Don't do it. You don't owe these people anything. Social media has a funny way of making you feel like you're obligated to do this stuff. Bullshit. You don't need to know what I'm doing. You don't need to know what anybody else is doing. But the ones that are willing to share it, they should be respected, because not everybody's willing to do that. And it takes I had a lady student of mine. She just mentioned that she's entertained the idea of live streaming, and I immediately said, don't do it. And thankfully, I had other students came behind and supported that idea, because if you're finding profitability now, and you feel the inclination and you want to go out and prove it to other people, because them telling you that you're doing it good, that's what you need, then you haven't done it enough to be bored with the results to know that what you're doing works. So stay right in the position where you're at right now, which I'm going to roll and circle right back to Matt Miller. Matt, if you're listening, I'm telling you, don't change anything. Don't increase frequency. Don't increase leverage. Don't change anything. If you're going to do something different, do it outside the accounts that you're doing what you're doing in now. Don't do anything differently, and you will have a banner year, a blockbuster year. And it needs to be boring. It needs to be boring. Just like a fucking job. It's the same mundane bullshit. You know, when you put the time in, you're going to get the same paycheck every week. It's going to be the same thing. You're not going to be surprised. You're not going to be like, what the hell happened? I didn't get all the money I was supposed to get. If there's a problem, you go to HR and fix it. But here, you are HR. You are the CEO. You are the boss. You're the captain of the ship. And you've said it audibly, you're fighting the impulse to do more. And you're reading comments, and the audience is telling you to do this and do that. Fuck them. Fuck them. They're not doing it. You are. You're assuming the risk. You're doing all the heavy lifting, but you're going to listen to other people give you advice. These people on social media are fucking wild. They have no idea what they're doing, but they're trying to advise other people. Get the fuck out of here. So my advice, sincerely, in closing, don't do more than what's necessary. Think about it, man. $160,000 in 2 months, or the equivalent of. You're killing it. You're killing it. And you had losing days and it didn't even bother you. And you live streamed it on top of everything else. That demands and commands respect. And you got mine. You got it. So don't change it. You have exactly what everybody else would cut their left arm off for. And you're walking it in front of everybody. And that's good. And you're not doing it with an ego. That's beautiful. You're not talking down about any other trader. Fucking beautiful. That's how this industry should be. That's how it should be. Not some drama bullshit trying to get some kind of clicks because you can't trade profitably. You got to delete your fucking streams. No deleted streams. Let everything as it is. When you have a losing trade, you leave it up. That's awesome. You don't make excuses for it. You own it. That's exactly how it's supposed to be. That's exactly how it is when you're really trading and you are by yourself. And I love it because I've watched a lot of people troll you and they ain't coming close to what you're doing. And that to me is fucking poetry. I love that. I love it, and I don't need to name them. They know who the fuck they are. Believe me, their fucking asses puckering right now because they were, oh, please don't say my name. We all know who you are. Broke. Broke ass motherfuckers. Well done, Matt. Well done. I will be here tomorrow. It'll be more specific with candlesticks, and we'll watch some stuff live. But I have shared where I believe the Monday, Tuesday, Wednesday draw on dollar is. I believe that all those things panning out, barring any event that would be inspired by a Middle East type thing, I'm confident that that's okay for my analysis, my approach to seeing things. But we got a couple seconds. Let me go over 5 minutes. Okay, I'll go over 5 minutes because I just want to take a look at the lower time frame. 1 minute. Always doing more. Yep. All right, so we had this parabolic drop this morning. Low, lower low. Rallied. What is this? What's that right there? Fair value gap. Buy side imbalance, sell side inefficiency because it's an up close candle. Ideally, what do you want to see? You want to see a piece left open. Did it fully close in that? No. Where did it trade to? The lower quadrant. You see that? Right there? Where's the bodies? See that? And then once it did that, what does it reach for? Premium. Premium relative to what? You have this range here, and then you have the larger range there. See that? I'm not going to refer back to this here because we've already had what happened. Well, that's your range of the day. Did we go above equilibrium? Yes, multiple times in closing basis. So you can't use that range now for defining short-term premium to discount. This low did not take that low out, but we had market trade higher. So we have to look at a shorter time frame range, which is inside the larger range of the day. So from this low to that high, above this level, we have to look for inefficiencies when we're retracing. Is there inefficiency in here? No. And then you have the short-term high, and you have this high here. Any inefficiencies over here? Not on this time frame. So that's using this range here. If you're using the even smaller time frame, shorter term range here, this is all trading inside the range, needing not to see it trade outside the range. It rallies here, your fair value gap there. See that? Where did I tell you the ideal entries are going to be at? If you're trading fair value gaps or bullish order blocks that are buys or bullish, it's going to be in the upper half. So there's your fair value gap. There's the high of it. Here's consequent encroachment. Oh, hot damn, look at that. Just seems to keep happening over and over and over again. And they'll tell you that's buying pressure. It's buying pressure. Oh, I'm feeling the pressure. So we have relative equal highs here. And then we have this wick. See how we've already worked consequent encroachment that multiple times in here? Because it's done that and it's rallying, I would want to see that buy side above the wicks high now, and then maybe revisit this inefficiency because it left a small little piece open right there. I'll draw that out. It's a rectangle. So for PM session consideration, if we continue to press higher, just look for it to trade into that. And then we have this inefficiency over here that was left open. And we'll do this. See how we went to consequent encroachment, that inefficiency there? Overshot a little bit, but look at the bodies. Then we had a breakdown. Shift in market structure. This model 2022. Where's the sell side? There. That's what it hit. Over here, Tuesday and Wednesday, we're going to do this stuff live where I'm pointing out things as we look at price as it's panning out, if I'm going to have it on a 5-minute, 1-minute, and a 30 or 15-second chart. So you'll watch everything live, and you'll see how everything agrees and supports or negates the idea of continuation higher or lower to a premium or a discount. But I wanted to introduce just the basics. This is like a real basic. It may not feel basic for some of you. Probably feel like, man, this is way too much, and you went over my head with a lot of things. And that's simply because you probably haven't been a student of mine for a while. But I promise you, the folks that's been with me for a while, they know what my PD arrays are. They know discounted premium. They know what an order block is, and they've struggled with when do you buy a certain order block, and how do you treat an order block, and what's the entry price, and what's your stop loss. I get so many questions for, like, where do you place your stop loss at? If I'm trading with a fair value gap, I'm putting it below the candle or above the candle relative to, if I'm buying or selling, the candle that creates the gap. That's what I'm doing. If I get stopped out and it trades back below or above respective to the fair value gap, in deference to it being a bullish or bearish PD array, I'll treat it as it needs to move out of it and then come back and retest it. And then if it does, then I'll enter there and I'll put the same stop loss I used initially. It'll be many times a little bit larger in terms of risk, but I've already reduced my risk generally, not all the time, but usually in the case of that type of setup, I'll reduce the size or leverage because I've incurred a loss. So I think that's going to be it for the first one today. I covered a lot of things that, in my journals, I went back and looked at my first 3 years and the things that I complained about. I addressed and tackled those big sticking points that I had initially. Now, obviously, there's a whole lot more things I'm going to cover and things that I'm going to use that have been presented to me by my own students, both paid mentorship students that I don't operate a paid mentorship anymore. Stop asking, because obviously you see I'm doing this for free now. I don't create content that is video or audible for paid students. We basically just hang out. Once in a while, I'll call the market with them. But whenever I get a student that talks out their ass and say, you don't make enough content for me, then I stop doing it for a week to let them realize the benefit they have of having contact with me still. But looking for setups like something like this one here, okay? If you were to take that long and only use the low of that candlestick right there, okay, your entry would be 864 and a quarter. So 864 and a quarter. If you were only going to use a simple bread and butter approach to just trying to make money, you're not out here trying to impress everybody with the full daily range. You're not trying to be ICT Junior or 2.0. You're not trying to be, Omni-Man of fucking trading. You're literally just trying to get money and get done and move to the sidelines and go live your life. You could use this pattern here, and the range that it is retraced from, that's this high right here. Be honest, okay? If you were able to find setups like this on a daily basis, buying inside of a fair value gap, the easiest sure thing entry, which is the only one that I think you should be worrying about right now, one tick below the candle that creates the highest parameter for the fair value gap. Because if this is the fair value gap, let me zoom in just to be more friendly on the eyes. Can you tell I love doing this? If my wife was here, I wouldn't be able to do this, but we made some arrangements. This candle here, okay, this is the fair value gap between this candle's high and that candle's low. This frames where your stop loss is. So your stop loss has to be at the body or the low. Depends on what you're willing to assume in terms of risk. If you want to be really aggressive about risk, you're doing trade with a larger leverage, then you're going to obviously go with the body. If you're more risk averse and you're not going to trade with large leverage and you're learning still and you want to give yourself some flexibility to stay in the trade and not be potentially stopped out, you're going to use the low of that candlestick. And somebody already done the math on it saying, well, this is a little bit too much of a stop loss for me because I usually trade with 3/4 of a point of a stop loss, and I'm trading with 15 contracts in a funded account, which is in a real account because it's not really going to the markets. Therefore, they're not going to tag your liquidity, and you think you're a rock star. That doesn't hold water, okay? you need to manage the risk appropriately and not try to squeeze every possible outcome that's the best case scenario for you. You need to be looking at how can this hurt me? Every trade should be, how can I make money, but reduce it to the minimum amount of money that I could go to sleep knowing that I lost it and nothing's going to change the way I trade. To me, that's the definitive answer that I had to assume for myself. Not what could I afford? Because what you think you can afford before you trade on ain't really what you can fucking afford when you take that loss. Because any loss sucks, especially for a man. Any loss sucks. A break-even stop out fucking sucks. It sucks. We hate it, especially if it starts to run off. But mature, personally responsible traders have to do their due diligence and determine how much can I lose today. And if I lose that, I'm not going to feel any apprehension at all doing the same model, same trade the next time it forms. And be honest, how many times have you done that? Probably never. And until I started holding my feet to the flame with that perspective, I couldn't stay in a trade or take the next trade. I would always get scared to take the next one. I'm 20 years old. Nobody's coaching me like I'm coaching you. Nobody encouraged me and gave you these rants and stuff. It's just I had to go through it. And I quit dozens of times. But quitting, if you're a trader, is just meaning you're taking a break or you're trying to save up money, put more money in an account. That's really what it means. But if you can't stay away from this stuff, you are a trader. So you might as well just start learning how to do it right. But the entry would be one tick below that. That's the easiest, no-brainer. This is how you do it. The stop loss is the low. Or if you are using larger leverage and your convictions are strong, you can use the body's low. In this case, it would be opening price. So the difference is whatever that is. How many contracts can you trade? I don't know what you're trading with in terms of equity, but you should be trading the least leverage that you can possibly do. That's a micro. A micro, okay? You're not risking a whole lot of anything, but you're learning. And then you just target the buy side here. So if you're trading 864, we'll just say you got filled at 864 even. Okay, 864 even, and you're getting out at 885 and a half, one tick above the high. Like, are you capable of finding 20 handles every single day right now? Probably not. But these types of formations happen every single day, and this is just a 1 minute chart. What happens if you take that and you get out, and you took that 20 handles and you're done? Then you come back in later in the day, but it went up 500 handles. Are you going to kick the dog? Are you going to take it out on your spouse? Oh, don't talk to me, man. I had a trade. I could have paid off this part for my car. I could have done this. I could have done that. If you do that, you're living in the rearview mirror. And it's always easy to find regret. It's always easy to beat yourself up about that. And that's not building you up. It's tearing yourself down. You made 20 fucking handles. That's more than Retail Rick with his harmonic horse shit. You made money. You banked it. You treated it like a business. Every business that operates isn't trying to get every potential fucking sale. They know it's not realistic. They do what they can within their means to try to get the people to spend the money, but they're not going to break their business trying to do it. And traders many times do that very thing. They do more that's necessary and aren't profitable as a result, and they keep doing that same thing thinking it's eventually going to crack and they'll be wildly profitable when they could just do exactly what I've preached. Find a low-hanging fruit objective. You're not trying to trade the whole daily range. You're not trying to pick the low of the day. You're not trying to pick the high of the day. You're not trying to get 100 handles every trade. You're just looking for something that's going to be easy. Go in, get it, be content with that, be happy with it. Fuck off if your opinion about that is you should have did more. Who cares? They shouldn't know what you made on your trades. Nobody should know that. Nobody should know that. That's your personal business. Why the hell are you letting somebody else run your business? Then you wonder why your shit ain't working right. Because you're letting everybody else come in and run it the way they want it ran. Yeah. I think that'll be it for today. I'm hungry. I'm fasted. My stomach's talking to me. I need to eat something, and I'm parched. So I do really want to sit here until that yellow box is hit, to be honest with you. If I was at the exchange, I would sink it though and say, fuck ICT. I'm going to drop this bitch 80 handles. Fuck you and your live stream. Come on, Pat, do it. But tomorrow, we've done all the preamble talk. Okay, we're going to go right into the charts, and we're going to focus primarily on ES and S&P after the 9:30. I'm going to look at Forex pairs, Euro dollar and cable tomorrow from 8 o'clock to 9:15. So 8 o'clock to 9:15, our focus will be on Forex. And then at 9:30, we'll transition into focusing on the futures markets and until around noontime, and then we'll break again. But obviously, there's a lot of things I still want to cover, and we have it, and I'm on schedule. It may not feel like I'm probably stuck to a schedule, but I completed everything I wanted to cover today. That's why I started cutting up a little bit. I did a fair enough job to beat my outline. So in that regard, I'm okay. But tomorrow, we won't have a whole lot of like explaining this, explaining that without looking at charts. Everything is going to be over price action from now on. So tomorrow and Wednesday will be literally immersion in price action live, explaining what it should do, what it shouldn't do, why it's useful, what would be problematic if it does one thing or another. All those things are actionable things. They're things that can be used in the future. That way you can learn from it, repeat it, apply it to what it is that you're studying. So the buy side, remember I was telling you over here, that wick and how we already went to consequent encroachment of that wick multiple times. That means we have to cancel that as a draw. It can't act as a draw anymore. It's not something we would favor. It's the high of that candle. That would be the one that would be the buy side. That would be the draw. Use the DVR setting I have on my. I don't have it turned off so that nobody can rewind it and take a sound clip out of it and put it on YouTube and say, no, you didn't say that. I'm saying everything in front of you. Not worried about what the outcome is going to be. So you can see how we ran up in there and engaged that liquidity. So if it's going to move up above that, how far can it go? That's a question I get all the time. Like if you're looking for a high to be traded to, how far can it go? How can you trust when I do turtle soups, when I try to sell old highs being broke and pierced, and I sell short as it's running through them? They're going to be instances where like it's an obvious PD array above a buy side that I trust is the final definitive target that they're aiming for repricing it to a deep premium before sinking it to a discount. In that case, or in this case here, the buy side resting above that wick. Just above it, well, how far can it go? Well, then you have this inefficiency. We've already traded to it, but see the difference between the high? Look at the high right there. That's this price up here. The high of that candlestick is 17,908.50. And in the low of that candle over here is one tick. That's enough for the market to want to reprice up there because it's a separation. It's a separation between this candle's low and this candle's high. So it's a SIBI there, sell side imbalance, buy side inefficiency. So how far can I and would I measure if it's going to go above it on high? It's this entire range. It doesn't need to do that, but that's what you aim for, and you trade it accordingly. So if you were long, say you took off, say you had two contracts, and you went long down here. You take one off here, and you let it run. The target was explained to you over here. That's the buy side, and then you want to sit back and wait for it to engage that. Then you have a choice. You either take it off on a limit at that level, or hold it and manage a stop loss to see if it can dig up into here and maybe even run off even higher. That's the purpose and the luxury of having a runner. You have the luxury of determining what you want to do with it. Do you want to cut it off at a definitive level? Well, I gave you that. It's right above here. If you want to let it run, if it gets to that point, how can you manage that? You use it as a trailing stop loss. Trailing stop losses prior to areas where a partial would be logical. If you're trading any position with a trailed stop loss and you're moving it up into a range from a discount and then you're entering the realm of what would be premium, and I'll explain that to you right now. In this example, you would have this. that high to that low is what we measured, and we would be in a discount still trading to this fair value gap, which is the first one that formed because there's no fair value gap in any of these up close candles. The market trades down into that fair value gap. That's your first entry that you can now target premium. Premium is defined by the high to low of that range. So midpoint of that, let me just pop it up real quick. It's a long 5 minutes, isn't it? That's how I roll, baby. That's how I roll. You always get more than you paid for. That's equilibrium. So minimum is to trade to that, but it does that, and then it comes back to that fair value gap. So now we're in a discount because here's equilibrium to the low. Discount. Then it's going to do what? It's going to expand up into a premium. So what premium arrays do we have? This high, relative equal highs, that wick I talked about, and I said that high. How far can it go above that? It can go up into this old range and bump that last up close candle. You either take it off there on a hard line limit to say, okay, my final runner, we're just going to call it a day there and be content with it. Or how would you manage the stop loss? Your stop loss cannot enter above this region here because you're entering into a realm where it can retrace still. So your stop loss has to be, oh, this will be a good place here. So whatever it was here, it's trailed up to there. If you look at my trades, that's how I'm managing them. Unless I'm real close to terminus and I have one contract left, then I'll trail it up to something that would be below here because there's a fair value gap and we already traded to it. So I wouldn't want to see that fair value gap traded to and go over, or below it rather. It would be failed. Okay, so it's a matter of context, where you are in the trade relative to where you were targeting, and the runner is where you want to finesse. The last little piece of your profitable trade, that's the one that you have the luxury to finesse. Whether you get stopped out on it, whether it goes to a hardline limit order and you exit out there, or you hold on to it and you keep your stop loss at break even plus commissions and costs and just let it rip and go see what happens. None of those outcomes are wrong. Because if you take it off at any time and it runs 200 handles, and if you would have stayed in it with that runner, you're going to consider that wrong. You're going to beat yourself up out of it. So you got to give yourself permission that any outcome on a runner in a profitable trade after you've banked partials, there's nothing wrong with anything that you do with it. There's nothing wrong with that. And that's managing your expectations. It's also managing your ability to stay within the context of a bias, whether it be the daily bias or the session bias. Yeah, I'm going to be content with this for today. All right, so I hope you had fun today. I hope you learned something. I covered a lot of stuff that were very important factors for me when I was coming up as a trader at 20 years old. And for me, if I would have had these things submitted to me as study points, things to reference and consider when I'm trading and developing, I could have shaved off years and certainly probably wouldn't have blown so many accounts as a 20-year-old. I would have probably done a whole lot better sooner because it would have given me processes, rules, what to do, when not to do it. And we're only starting. This is only the beginning. There's a whole lot of content still that we're going to cover between now and Wednesday. But for the first day, I think I've covered enough, and I've given a really good foundation to everything that will be referred to in technical terms over live price action. So have yourself a very pleasant day. Hopefully you enjoyed it. If you did and you appreciated me spending my time with you, give it a thumbs up. It doesn't cost you anything. I promise it doesn't make me any more ad revenue. It's just a way for you to kind of as applause. Okay, if you get something out of it, that's what I'm looking for. If you don't put a thumbs up, I won't know. I don't really give 2 bucks. I don't care. It ain't gonna change the way I live. It ain't gonna change what I eat. It ain't gonna change how I sleep. But it's just a way for you to give me feedback. Okay, so that's your way of saying I got something out of this, and that's how I'll look at it. And I'll talk with you all tomorrow at 8 o'clock, Lord willing. Until then, be safe.